Hello, hello, hello. Hey guys, what's going on? Surprise, we're doing a stream. Hey J Ruff. How's Hey Dave. All right. Just letting you guys know we're already live. I've been looking at a couple of different tickers. I'm trying to catch up with everything that's been going on lately in the market, which, I mean, nothing good, but I've been looking at a couple of other plays and I managed to find one that was unfortunately just a little bit too late to catch this nice big move. But I was looking at Ollie's discount and bargain closeout stores, and so I wanted to show this new play to folks because I think this could be a good value play in the face of a big um, market crash. It might be one of the few plays that actually performs well on the long side versus taking a short bet. So I want to go through this play first, and then I'll go ahead and take requests. I'll catch up with you, chat, and we'll figure out what everybody else is interested in seeing. Okay. So, Ollie's Bargain Outlet Holdings is a company that they have basically closeout stores that offer huge discounts on name brand products. You could think of it like TJ Maxx or Marshalls. You know, they collect their product from stores that can't sell their normal product, but Ollie's specifically gets stuff that can't sell at places like Walmart and Target and BJ's and Costco and stuff. So what their big market is they go and find a product that one of those big chains is trying to offload. They buy all of it super, super, super cheap, and then they make a 40% markup on, or they make a 40% profit margin, or at least that's their target profit margin off of that product. So what's really interesting about Ollie's is if you compare their performance to tickers like Dollar Tree, um, Dollar Tree is a very interesting one because Dollar Tree actually performed exceedingly well during the 2008 housing crisis, and it's one of those few. It's one of those few plays that works out well because it's actually beneficial to the consumer in a situation where the entire market is, where consumer confidence is at an all-time low and people are really trying to save money and are strapped for cash. So because of those situations, stores like this do particularly well. And as you can see, Dollar Tree, which is this orange line chart, starting in October, they announced a really fantastic earnings and they went absolutely bananas. And everybody was worried about inflation. So Dollar Tree, of course, was able to maintain low prices and keep product moving out the doors. So the problem with Dollar Tree is that one, it's already moved a significant price. It's now up at like $161. They just had announced earnings and their stock went fucking bonkers. They're currently consolidating now, but they're still basically at all-time highs. So I was looking for a play that would actually work out that hadn't quite made that big move yet. And funny enough, my wife pointed this out to me that this store was really undervalued. So I was like, okay, and it took me some doing to do some research on it. Um, Hell's Trading Floor's own Occam's Phaser went ahead and did his own technical analysis on this stock. And on the charts with the technicals overall, it's not looking the best, but it is also setting up multiple signals for reversal pattern, as well as being just a generally undervalued play. Now, here's the reason why Ollie's hasn't done well recently during the pandemic and the recovery period. I mean, they did really well out of their IPO. They uh, started doing really badly leading into 2020, and then they hit their lowest point during the COVID panic, and then they surged massively so that their price had returned to all-time highs within a single month after the COVID crash had hit its worst point ever. And then they just slowly kind of died off from there. So the big problem with Ollie's was that they didn't have their own distribution and transportation for their product. That they were basically relying on their merchants to get the product to them. So that was putting a huge burden on them for a cost perspective, because they were basically relying on one, for their merchants to not only give them a product that they were willing to sell to them for a super, super, super cheap price just to get rid of it and open up the space in their own stores, and then Ollie's would take it off their hands. But Ollie's was also requiring those merchants to deliver the product to them, which was a huge cost burden that most were unwilling to tolerate. So Ollie's has spent the last 2 quarters building a bunch of distribution centers and a fleet of shipping trucks, which they've now completed as of their latest earnings call. And even though they missed on earnings, they're currently moving big time. They had a 5% move today, and they're up $13 on the week. So it's a huge move, just seemingly out of nowhere for no explainable reason. There actually is good reasons. I actually went and listened to the previous earnings call back from late March, and there were more than 20 analysts from different institutions, including major Wall Street hedge funds and banks, that were all interested in this stock at the same time, and they kept the staff on for over an hour past their deadline time to keep asking them questions. So there was a lot of interest in this stock a quarter ago, and the big thing that Ollie's was promising was that they would get their stores updated, that they would have a fleet of vehicles, that they would have their own distribution centers, and that they would be able to more freely move product, and that by the third and fourth quarter of 2022, they would be fully autonomous and independent on all of those fronts. They hit those targets. They have all of their distribution ready to go. They've got their trucks, and they are ready to start moving product to newly updated stores, and they're opening up. By the end of the year, they expect to have more than 550 stores open. So there's a lot of upside in this. It's a good value play because, unlike Dollar General and Dollar Tree, they actually sell the same name brand products that Walmart, Target, BJ's, and stuff sell. And they also sell non perishable foods, but they sell product that is either off label or outdated or no longer being offered. And they basically sell the product that the other retailers don't want to sell anymore, and they need to clear the space off their shelves. So it's good product. It's better than what you find at a dollar store. They still pay premium prices on the product, but Ollie's is able to get a huge markup, so their upfront costs and their overhead on everything is way low. So there's a lot of big benefits to this particular play on the long side. This is one of those plays that, if you're looking to invest in something like this, is kind of like a long-term horizon. But I do see the potential where within the next 90 days, it is possible, not saying likely, but possible, that Ollie's could return to its previous all-time highs above $90. So it's possible. I want to caution people against getting all euphoric over that idea, because we're currently in a really bad situation nationally, and it's not a good environment for taking long bets on anything right now. However, Ollie's has one huge advantage in this high inflation, high interest rate environment, and is they have virtually no debt. So since they have no debt, they don't have to finance anything, and their long-term assets and short-term assets far outweigh their short-term and long-term liabilities. Big thanks to Occam's Phaser for doing the financial analysis on this to find this data. So, all that being said, Ollie's has no debt. They've got their own distribution and transportation set up. They're continuing to get cheap products that is basically name brand, but at massive discounts that nobody else will be able to compete with. And they're now launching their first online flyer so that they can get people in their stores. And it is true that based on the locations of where their stores sit at, that people are willing to drive 20 to 30 miles just to get to these stores in order to get the deals for their product. So there are huge advantages for this particular retail chain, and I'm actually pretty optimistic. I'm very surprised to find myself betting on a discount store, but it's one of the few stocks that I see long-term potential in to go to the upside during this huge inflation environment. So that's pretty much the play. I am long in this stock, so of course, take what I say with a grain of salt. I'm biased, obviously, but hopefully, you'll be able to do your own research and come to a similar conclusion that there is some value here. It's just a matter of if they can continue to perform and continue to move product out the door during the upcoming recession, crash, or whatever is about to come. A little bit on the technicals, they are way oversold. They exhibited a falling wedge here on their long-term daily chart. So this chart pattern right here. Let me go ahead and change these colors so it's a little bit more visible. This falling wedge pattern is a bullish pattern, and they had a very clear breakout here above $40. So that was pretty much their bottom. Their stock IPO'd at $20, and they've not retraced beyond that. Their lowest point for their stock was during the COVID crash, so I wouldn't necessarily count that, since that was kind of like wholesale panic across the market. But obviously, there's some strength in it. And one other thing that I'll also point out is most of the stock is held by institutions. They currently have a float of 54 million shares. That's all they got. So not a lot of float to work with. So this is a stock that can move rather quickly. And their short interest was actually surprisingly high. Apparently, there wasn't a lot of faith from investors on the short side that this store was going to survive. The utilization isn't quite maxed out, but if I show the estimated short interest, the short interest during October, December was pretty high, and it's been oscillating around, but slowly on a downtrend. Still at about 13.5% short interest over the free float, so around 8 million shares sold short against the stock. So that's it's not bananas shorts like, oh god, there's fraud going on here, but there's a high amount of short interest that could actually put shorts into a pretty big bind if they don't get out of their position soon. And it seems like the majority of those shorts took the hint and got out of their positions while they were up, and they were able to take some profit on that. And now Ollie's is beginning to turn around. So now that they're now showing some new highs, I'm willing to bet that shorts are going to start evacuating this stock if the thesis holds up that they're going to perform well during a recession. So that's pretty much the Ollie's analysis. I'll go ahead and move back to the charts, and we'll go ahead and take a look at some other plays. What do you guys say? All right. So, okay, Joe had it first, AMC. We'll go take a look at AMC. So AMC still showing some pretty good strength. Where the the 50 period moving average on the daily is getting very close to crossing the 100. That would be a golden cross. It's kind of funny. It suddenly took it took a turn back down, and they sort of just bent away from each other. But AMC is still showing some strength at 1350. If we can see AMC take another shot at this resistance here at 1550, I would venture a guess that we start to see this forming a rising wedge or a horizontal wedge. What I would be looking to see AMC do is start to tap against this resistance and kind of do this before it broke out of its consolidation. So still got a ways to go for AMC for that to play out. On the, let me actually go get my timeline out, my tinfoil hat timeline. Go get rid of this shaken money flow. Okay. All right, here is the tinfoil hat timeline. I'm considering now maybe deleting this because I've extended it out multiple times, and at this point I don't think that I can necessarily justify it anymore to think that this is holding true at all. There was volatility in this period that I had called out before, but it kind of collapsed on itself, so it didn't work out the way that I had anticipated. So I don't want to contribute to any kind of hopium for that reason. So I'm probably going to delete this if after this next period ends at the end of June. Then I'm just gonna wipe this slate clean because all of the confluences that I had built up around AMC's squeeze didn't play out, and if after this last one, if I don't see a big move coming up in this period between now and early July, then I'm just going to go ahead and scratch this. It's kind of busy anyway. Like it got really crowded. But anyway, on the actual TA, we've got multiple areas of resistance that we've been testing here. This one in particular was repeated support that we touched 1, 2, 3, 4 times and then broke down through the 5th time. And since we've bounced, we have retested it as resistance once, twice, and now a 3rd time. So I'm curious to see if we can get this, if we can break through this resistance one more time and get above the $14 level and break through the $15.50, $16 level next. So that would put us on track to break out of AMC's overall falling wedge pattern, which is that's these two. That's these two here. I apologize. I know that like all of the purist technical analysts are. I know all of the purist technical analysts are probably like vomiting in front of their keyboards right now, looking at how dirty my chart is. But what can you do? So, if you haven't already and you're liking the stream, then you should let us know by throwing a like down on the video, and please feel free to share this on Twitter and with other people so that we can have others join the Hell's Trading Floor crowd. And if you're not a part of Hell's Trading Floor, I'd really encourage you to take a look. We're a very friendly community that's focused on education and value plays. We're, for the longest time, squeezes have been our bread and butter, but lately we've been trying to focus on ways for people to consistently make money, focusing on trading education, and for that reason, people have been starting to win a little bit more lately. I'd say that we've been doing very well on our bearish plays. So one of our big focuses is to educate people on how to take short bets and why that can be a good thing. It's actually a rather good thing to be able to spot good short bets so that you can make money while the market is going down. And right now the market is down. So overall, it's important to recognize the value of being able to play both sides of a trade, and recognize that we have reasons to be cautious or fearful of the market right now. Market has been showing a lot of weakness. We've had multiple death crosses on multiple time frames and periods on the SPDR 500 index. So the market's, it's kind of sick. It's not doing well. So we want to make sure that people are able to make money going in both directions. Let's see. RDBX. Sure, we could take a look at that one. I'm actually very bullish on RDBX, but I don't have a position in it anymore. I got washed out during this big hunt here, and my portfolio was so deep in the red. I was facing the possibility of a margin call, and I had to exit. I was really sad about that because it felt like not only did the rug get pulled, and I felt very cheated, just because the company Chicken Soup for the Soul that decided to buy Redbox was going to basically throw pennies in front of retail investors. And their conversion rate was a total joke. But retail has since proven them very, very wrong, and Redbox is starting to show signs of a squeeze. I'm basically out of capital to take a bet on this, but I'm rooting huge for retail right now because Redbox is starting to look volatile as hell, and shorts are absolutely backed up against the wall. I'm loving the fact that retail has been able to consistently prove institutions wrong on these high value plays and these overshorted stocks. So I think that the thing that will tell the story the most clearly will be to look at the Ortex data for Redbox. So we'll go take a look at that now. First of all, let's go ahead and take a look at the utilization, get that out of the way. We see the utilization's been maxed out since March of this year, and that basically brings us all the way back to the beginning before Redbox was even widely known about by retail investors. The overall short interest over the free float is up to 172.5%, which is frickin' ridiculous. The cost to borrow is murdering shorts right now. Annualized, they're paying on average 8 times what their notional value of their short bet was. So if somebody paid $100 to take a short bet, then if they held that position the entire year at these current fees, then it would cost them $800 to have held that position, which is hilarious. And I'm I'm laughing so hard every time I look at this chart, just thinking, oh my God, shorts have to be bleeding so badly every single day. And yeah, they are freaking desperate for retail to cover right now. There's no valuable justification for why Redbox is this high, because Chicken Soup for the Soul has basically said we're going to buy this, and it's ours, like we own it, and we're just going to offer like this really shitty conversion rate for investors if they stay in their positions, which is basically a way to force people to exit. And in defiance of all logic and market structure, retail is continuously buying the stock and holding it despite that, which I'm so proud of you guys for, because for one, it's hilarious. I love seeing these hedge funds that have been shorting Redbox unjustifiably into the dirt. I feel like they were a target at one point, and maybe still are. And I think that this is costing them every day. And the fact that the price is still moving up in spite of all of the bearish reasons for the stock to be going down, the fact that it's going up anyway and causing the cost to borrow to go higher and higher and higher is just hilarious. It's the funniest damn thing to me. Let me see. catch up with a few people. Would appreciate it if I'd touch on Biora again. It was close to 85 cents not too long ago. Yeah, I would love to take a look at Biora. Let's double check a couple more of these things. Yep, Redbox still on the threshold list. Security lending volume still ridiculous. Shares on loan still ridiculous. The shares on loan compared to what's being shorted doesn't make any sense. Like that doesn't make any sense. Man, this is too funny. This is just too funny. Okay, well, I'm going to go ahead and walk away from Redbox for me, but I'll continue to cover it for you guys and let you know my thoughts on it based on the charts and the and the look of things. It's extremely bullish. Like this is this would appear like a very wonky inverse head and shoulder pattern, or maybe you could look at this as a cup and handle. Perhaps I'll go ahead and switch over to the. I'll switch back over to my trading view charts and put this on an hourly time frame so that we could see this a little bit more clearly. But we do have this U pattern. So we got one big U and then one little U, and it's starting to break out here. So this is a classic cup and handle pattern. One big U and then one U that comes about halfway down and then rises back up. So you're right there. This is actually right at the entry point for a traditional cup and handle pattern. So if you are watching charts and trading purely on chart patterns, this is actually the buy point for the cup and handle. It's showing strength, and it appears ready to make a big move, and the volatility in pre-market trading corroborates this because we saw the price spike up past $11, which is just nuts, man. I really wish that I could have held my position. Believe me, nobody's more upset about that than I am. So we'll go ahead and take a look at Biora now. So Biora is starting to show some strength. I've noticed it bouncing off of support here for the second time in the last week at 75 cents. So it just won't stay below here. It broke down once back in mid-May and then made a big retrace and formed a cup and handle, but the handle broke down and it's been consolidating downwards since then. So let me take away, let's see. Let me take away the after hours trading session because it doesn't really matter as much for this stock. Yeah, for Biora, we have this inverse head and shoulders, or you could look at it like a cup and handle, but it just didn't play out. And now we're starting to see the price just consolidate sideways here. But on the plus side, on the hourly time frame, we have a golden cross here. The 50-period moving average and the 100 both crossed above the 200 on the hourly. On the daily, they're still pretty far apart. We've got to wait a little ways because at the moment, the 200-period moving average is way up here at $1.70. And everything is just starting to show consolidation. It's just still going sideways. So at the moment, there's not much strength to speak of on the long-term time frame, which is disappointing. But we're still waiting on Biora to get its clinical data trials out for its its oral biotherapeutics delivery system and the drug delivery system for oral drugs such as adalimumab and tofacitinib. I think I managed to say those correctly. It's AERC I see is being asked about, AERC. Aeroclean Technologies. This is one that I would say be careful of because I mean it squeezed obviously. Like this is classic squeeze, big move. Over the past week, it moved from a low of $2 and hit a high of $14.23. That's a big move, more than 150% move in just a single day. In a week, it's moved by in a single week, it's moved 320%. It would have been over 100. It would have been over 400% on the high side. So it's starting to show some weakness. Let's look at it on the hourly time frame. Yeah. So the volume is going away, and you have all of these moving averages, which are very, very far away from the 200s. So you have to be careful here. The point where I would say to go short is if you see some bearish divergence on the RSI. So if this price makes another move up and you see that the RSI is down below this high, this is very important. Technicals play a big part of this when you're reading a squeeze. And this is the one thing that I would be careful of because you can't trust the moving averages anymore. They're going to be too much of a lagging indicator. So you have to look at short-term time frames and pay attention to the moving averages. So there's a couple of things that we have here that are, we'll start with the positives. So we've got two big green engulfing candles here on the 7th and the 8th of June. And we are starting to see some strength and continuation. So this would be kind of like a bullish pennant. I would definitely say that this is a lot like a bullish pennant. You got this big move to the upside and then consolidation down in a narrowing structure. So this is a bullish pennant as opposed to a bull flag, which would be more square, like so. So what you would want to see is for this to break out above $10 and to show continuation. If you get that move, then what you're looking for at that point is for the RSI to show divergence. So you can do this on the 30-minute, the 1 hour, or the 2 hour time frame. Personally, I would use the 30-minute, and I would check to see if this price hits a new high. If you're betting this long, then I would wait to see where it hits a new high, and then look at the RSI. If the RSI shows bearish divergence, that's where the price here. And let's go ahead and mark this out. So let's say that you get this breakout and the price goes up to here, right? But if the RSI only goes to here, that's bearish divergence. That's where the RSI, you have this high in the price here, is lower, the RSI is lower, but the price is higher. So higher high on the price, lower high on the RSI, this is bearish divergence. So if you see this, then this is your exit. That's the point where you look at this and you say, okay, now it's going to come down. So you take your exit or you go short at that point and try to see if you can recapture profit going back down to the downside. So just that's what I want to warn people of. These things don't go up forever. It's dangerous to think that they'll go up forever if you're not in it. Honestly, if you're not in this already, I would stay out of it and wait to see what it does. If it starts to show weakness or you start to see divergence on the RSI, that's the time to go short on it and ride it back down. It's already made huge moves, it's great. I'm glad everybody's winning, and that's a fantastic thing, but just be careful. Please be careful. Okay, let's see. Let's take a look at Excella. I saw a request for Excella. Let's actually take I'll take the Discord's request first. IMPP, that's Imperial Petroleum. It's a nice move. Got a nice cup forming, but it hit resistance here. So at least in the near term, I would say just wait it out. If you start to see weakness, if it breaks down below 70 cents, then that would probably be the time to exit. But you do have on the long time frame, you have all these crosses on the 30-minute, and on the 2 hour, I suspect, yeah, you're looking at the potential for a golden cross to take place here in the near term as well. So if you see price consolidating here below 80 cents and it stays here below 80 cents but above 70 cents, if the price continues consolidating, then that would be a big show of strength for the stock to make a big turnaround. And it's possible that you could see it make its move back towards $2. What you'd be looking for in the long term is for the green, which is the 50 daily or the 50 period moving average, to cross above the 200 period moving average. The 50 and the 100 is a good cross for the short term, but for the long term, in order to get confirmation of long-term bullish momentum, you need to see the 50 cross the 200 on the honestly on the daily. But if you're looking for some conviction, you could look at it on an hourly time frame, and that would be at least enough to convince me. Okay, this one could be going. This one could go long, at least for the next several weeks for a swing trade. So you've here on the hourly time frame, this is exactly what I'm talking about. You see you have a cross of the 20 period and the 200. You would need to see the 50 do this same thing, the 50 period crossing the 200 right about here. So as long as the price stays up here and it holds up this position above, I would say 75 cents ideally, is where it needs to ideally hold support. If it breaks below that, then you're looking at it coming back down to 70, and if it breaks below that, then it's not going to stay up at all. That would be my those would be my thoughts. Yeah, sure thing, Lazeman. Happy to help. Wow, we've got a lot of requests. I am gonna try my best to get to everybody. Let's go take a look at Cita. Looks interesting. This thing really got hammered. Big gap here at $2. Big gap at $2. So you're looking to play this for a reversal, I'm assuming. I'll take a look at. I'm also going to assume that there's probably some short interest on this one. Otherwise, I know most people are looking at it like that. 15% short interest of the free float, and it's on the threshold list. It's been on the threshold list for. I'll go ahead and show my screen so that people can see this. It's been on the threshold list since May 27th, so that's pretty decent. The current short interest is got a big spike in it, which is interesting. Don't know what's got shorts so convinced that this thing's going lower than $1. I would say be patient. If it's going to start showing strength, then it'll do it on its own. You don't need to get in too early on this one. Definitely don't take up any options or anything like that if you're doing something like this, because you don't know how long you're going to be waiting in this consolidation for, and theta will eat you alive. If you're determined to take a position in this, it's better to go long on stock and hold on to it, but you could be holding a long while. You don't know how long it'll stay down here. So I would wait for a big show of strength. Let's see what the charts say. On the daily, you've got some good signs of bullish momentum. This big move in the price on the daily chart could cause a cross of the 50 and the 100 period moving average. So if that is what you get, if the price stays above $1.20, then yeah, you could see the price start to climb a little bit further. But you've got a long ways to go, and it's touched this resistance multiple times. So there's a possibility that it gets rejected here and falls back to where it was. And if that's the case, if that's what happens, then you'll be glad that you didn't buy any calls, because they won't have any premium left in them after even like a week. So be really patient with this one. Be super careful. It's got it's I agree it could be oversold, but you don't know the reasons, and I don't know the financials of this company. So yeah, it might be there may be valid reasons to there may be valid reasons to for there to be so many shorts against this company. I do see that it's a micro float though, so yeah, yeah. Be careful with this one. I think it'll consolidate for quite a while yet. See ENPF or ENPH, Enphase Energy. Interesting. Okay, so this is a semiconductors company. Very expensive. Performed really well throughout 2021. Looks like it's still doing really well. I see this cup and handle here on the daily chart, or I suppose you could look at it like a double bottom. The move kind of already happened, but I do like energy stocks for the long term because I think that they'll perform well.
Be up and coming on in line with that very thing. It's in a very interesting spot.
Yeah, I could agree with that. One thing that I would tell people to be careful of is that on the daily chart, the moving average. Oh, I see. I was on the hourly. Okay, so on the hourly, the moving averages are really far apart. So in the near term, it might come and retrace a little bit. On the daily, though, I can see your point. It's starting to show a lot of bullishness, and there's a big golden cross here. It's been teasing. It's been teasing. The golden cross happened way back here once, and then it crossed back down below again. So there's this point where the price just wasn't quite driving it enough. I think that you'll get it now. So this could actually be a good time to take a long-term swing. I might try to get a better price and I don't know, scalp it to like 190, 195.
Yeah.
Um,
Right now, I'm day trading a couple of options, like really short ones, just to try to pump some capital into the coffers here. But this is one that traditionally I'd buy. Traditionally, in the past, I've bought shares, and could potentially be a good one to try. I'm actually thinking about trying loading up again on some shares and trying some either selling calls or selling puts, and doing a covered call or a covered put position.
right on. Okay. Well, I'll take a further look at this one at a later time because I am looking for energy stocks to go long on. Things like SPOW and First Solar, I think, are pretty good picks for the future. Just because I feel like overall oil is not going to do well in this high inflation environment. They'll be able to gouge people for prices, but they won't be able to do it for the long term. It's going to force people to make some decisions. And in terms of like the geopolitical spectrum and the events that are going on right now, people are really angry with oil in general. And just, I feel the sentiment shifting towards solar and clean energy on the whole. And I know that Biden's administration is going to be very hyper focused on getting off of oil and into clean energy. And solar is really the most viable thing that we have right now. So anything in solar and semiconductors and EV, I feel is probably going to do the best, especially if it is cheap and up and coming. Let's go ahead and take a look at the other tickers that we've got listed here. Man, I see that we've got a lot of people looking for all kinds of tickers right now. Tony Smith. No, we're not sacrificing children to the stock market. Okay, Mullen. That's right. I was going to look at Mullen. So Mullen is still showing some consolidation, but there's just a little bit of strength in it, just a little bit. The daily chart is showing that The moving averages are starting to turn around and try to push on that 150 level. So what I'd be looking for is on the daily chart for the 20 to cross the 50 and get above $2 again. The the thing with Mullen is that it's still currently being hammered down. Calls are probably not going to do well in this anymore. If you're going to go long in this company, if you believe in this company, I know that there's been a lot of fear with the source of financing and the situation with the company overall. It would appear to me that they're at least getting into a better position, and I suspect that they're going to lock in that loan with with the subsidized loan from the government for electric vehicle manufacturers. So if that does come to fruition, that would put Mullen in a very strong position to capture its share of the market. The the short interest is its own situation with Mullen. If there is the possibility of a short squeeze, still is up for debate, but I do think that it is possible. The thing that I'm just trying to caution people about is that we're walking into a dangerous we're walking into dangerous territory with inflation getting so out of control. People are going to be very hesitant to make any big purchases, especially on a car. So I even think that we're about to get into a situation where people are going to be losing their vehicles, and a lot of cars are going to be going to auction, and the used car market is going to explode with supply, and that's going to really depreciate the value of automotives altogether, and it's going to make it hard for any vehicle manufacturer, whoever it is, to get their product out to consumers and get sales up. So it's going to be difficult. They've got an uphill battle ahead of them. If you want to support Mullen, then I strongly urge you to consider the dangers of going long with options and instead choosing to purchase stock instead. If you're going to go long in any company like this, um, as much as I am in huge support of a short squeeze, I also have to recognize the dangers of options. So um, there's just remember that options equals liquidity for market makers who are not in favor of short squeezes. They don't like that kind of volatility. They're very much against it. So if you're going to go long on something like this, it's better to do it with stock because you'll at least have equity. There will be intrinsic value in that no matter what. There's no expiration or anything like that. And further, just in general, Mullen, its strength is going to come from its retail investors because its retail investors are what's going to be propping up the value of the company because it's a speculative growth company going into this high inflation possible recession in the future, which I am very confident is going to happen. I'm very certain of the possibility of a crash. It's not a good thing for companies like Mullen because crash environments do terrible, terrible things to luxury automotives and travel, and that's exactly where Mullen is. So they're in the wrong market for what's about to happen to the country. So that's just why I caution people. Um, just know what you're getting yourself into. Don't just go throw a YOLO bet down on some call options for next Tuesday or for next Friday because that's not that's that is a good way to that's a good way to flush some money down the toilet. Overall, still bullish on Mullen for the long term. I think that if their company survives what is coming, then they can absolutely be a great car manufacturer, but they are still a newcomer. There's still a lot of unknowns. So if you're playing this for the short squeeze or if you're going long for the long term, shares is probably your best bet. For your as far as support and resistance goes, your nearest support is at 94 cents. It's broken multiple levels of resistance at this point, and it's got a really strong base of support at 94, 95 cents, or even a dollar. So that would be your risk level if you're day trading this. A breakdown to a dollar is probably the worst that you might expect for this in the short term, but long term, we don't know what's going to happen. So Upside to this is between $2.50 and $3 over the next 90 to 180 days. So you could be holding this for a while. Just want everybody to know, like, what you're really getting into. Okay, that's enough on Mullen. When does the chicken soup takeover actually occur? That's not known at this time. They still have to close out the filings and paperwork, so that's going to take them a while. We don't know how long that's going to take, but usually it takes about, I would say, between 45 and 60 days, so could be up to 2 months waiting time since their announcement. We're about halfway through that now, so um, it could be happening within the next 3 to 6 weeks. And also, I did want to remind everybody, if you're really enjoying this stream, if you're getting something out of this, and if you're finding value in this, please leave us a like, and please consider subscribing to the channel. It really helps us out. We do updates like this very frequently. I'm going to try and get on a better schedule so that I'm doing this more regularly. But one of the big things that we're also doing is we spend a lot of time in our Discord chat. So if you're interested in being a part of the community and getting access to the voices and the minds of all of our various experienced professional traders in the floor, you can come and join us at Hell's Trading Floor by visiting patreon.com/the devil's broker, or you can find us on Discord at discord.gg/Hell's Trading Floor. You can sign up through our Patreon. It's only $3 for a trader membership. That's the lowest that we could make the price. You can hang out with us. You can chat with us in the trading floor, and I pop in there pretty frequently, just from time to time to talk with everybody and give them some personal TA, and give myself a break from YouTube. And of course, there's multiple mods and traders and analysts that are there they're just there every single trading day, so there's always somebody that you can ask questions and learn stuff from if you're new to the markets and still need a little bit of help figuring things out. Let's catch up with Discord again.
It's getting lively in there again too. It's nice. We've been since the market took the turn, I think a lot of us had both life and also burying our heads in the books trying to figure out how the hell to trade this thing. And I feel like we're all kind of coming out of the clouds a little bit, and it's noticeable. It's picking up in the Discord quite a bit.
Let's be fair. There's a whole solid group of bears in there that were making money hand over foot while these things were dropping. There's people in there making money both up and down.
Well, while we're speaking of bears, summertime's coming. I think it's important to keep yourself pretty liquid. Summertime's coming, volume drops out. Pretty slow time of the year for the market.
Most definitely. And the thing is like we've got a lot of negative reports that are about to come out, and it's going to affect the market. I'm expecting the consumer price index, that's basically our barometer for what inflation is doing, is going to have a terrible outlook for what's about to happen. And on top of that, we're going to be getting new numbers on foreclosures and housing listing prices. The monthly reports from Fred are likely going to show a huge leap in housing supply and listings for the real estate market, which is like, the real estate market is it's a gauge for how the entire United States economy is going, because our whole economy, our stock market, everything is based on people's ability to afford homes and the demand for homes. So if the housing market is healthy, so is the stock market. If the housing market gets unhealthy, then everything gets sick. And now we're heading into a high inflation environment combined with a housing crisis. That's going to be terrible for absolutely everybody. And the Fed is about to unwind its balance sheet of I think they're unwinding more than $5 trillion in assets that they're trying to get rid of over the course of the next 2 years. and they're going to be raising interest rates by 50 basis points at least for the next 2 years as well until they get inflation under control. And I don't think they're going to do it. I don't think they're going to be able to do it. I think that we may end up in a situation where we're back to the era of like Paul Volcker, where they're going to have to drive the interest rates up like 10, 20%. It's there's some very real possibilities of some negative impacts to the stock market just because real estate is so freaking expensive. Living expenses are just so high. Energy costs, gas prices are through the roof, and all of the retail chains like Walmart, Target, and the wholesalers like BJ's, Costco, they're all reporting terrible, terrible earnings, and they're not doing well. Nothing is pointing. There's no situation, there's no piece of data that we can look at that says that the stock market is healthy or that the housing market is healthy. Anybody who is telling you that on the broad spectrum, it can be different in individual localities, because some metro areas are just insulated a little bit differently. There's different reasons for why people will be moving there or not moving there, but it's just a fact at the moment that there's many metro areas that are way overbought. People spend too much money on their homes, and it's getting very expensive to live. And rental vacancies are dropping rapidly. So people are moving to rent because no one can afford a house right now. So there's many, many factors pointing to a big recession coming. Oh, and personal savings is at an all-time low. People's savings accounts are damn near empty right now. So not good. Like there's many things to be concerned about. It's important that everybody at least look at the data and take note that we have an uphill battle ahead of us.
Short time frame. If you're looking at this channel that SPA's been in, if it doesn't pick a direction before CPI comes out, CPI is going to dictate which way it goes.
Yeah. When is CPI coming out? It's coming out.
It's Friday morning at 8 a.m. I think, or
right.
is it 9?
Well, I know that it's going to be before market opens. So either way, if CPI numbers are bad, like I think the latest report was 8.2%. Let me double check. Check the economics. Yeah, United States core CPI. Not exactly the figure I was looking for, but it does illustrate just how ridiculously high the CPI is rating costs of living in the United States right now. It's at record highs. This is the highest that it's been since 1993, or I'm sorry, 1990, and it's rising faster than it has ever before. Like this is on par with what happened back in the 70s and going into 1980s. This is a rapid climb in inflation that we have not seen before since that time period. And that was when Paul Volcker came into the Fed and decided, you know what, if we're going to get this under control, we got to be tough on everybody. So they raised interest rates up to 18, 20%. Same thing you see here. Yeah, inflation is currently sitting at 8.3. It had a high of 8.5 or 8.6, and it only barely came down. If we don't see this thing coming down below 7%, then it just tells us that what the Fed is doing is not working. And there's been another surge in gas prices. So if oil is moving up, it's going to make everything expensive. It's not a good look. Oh, and by the way, just a heads up on this, the CPI index does not account housing and real estate in its figures. So the most expensive commodity in the United States and the object, housing, that props up our entire economy is not accounted for in our inflation report, which is stupid. So it's not telling the whole story. This CPI index is not telling the whole story. So it is not reflecting the full reality of the situation that we are currently in. And the Fed has been trying to keep everybody calm for a long time. It's not working. Consumer confidence is at an all-time low. So there's many, 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 many reasons. And there's a lot of evidence saying that nobody believes that the market and what's going on in the country is good. Nobody really believes it. So before you listen to the first article that says to go long in the stock market, just stop and take a fucking second to think about it. Think about how expensive everything's getting. Think about how hard it is to live, how to afford rent, how hard it is to get gas, how hard it is to get to work, how hard it is to get your car fixed, how hard it is to make your car payments, how hard it is to get a loan, all of those things. Those are factors that tell you that things are not good and the market is going to react accordingly. And right now, my suspicion is that the only reason why the market's pumping at all is because there's a bunch of freaking banks and hedge funds that need people to sell, to buy their shit and take it off of their books. So you do not want to be a bag holder. What is about to come is going to hurt everybody, and all of the major institutions know it. Listen to the words of the I forget his name, Jamie Dimon or whatever, CEO of J.P. Morgan Chase. He has said publicly that the interest rates are rising and it's going to put pressure on the banks and the consumer. And that, for him to say something like that out loud, it is an honest statement, but it is not telling the whole story because he knows that it will cause panic if he actually tells the whole story. So there are reasons why there are fear-making statements being made, but they are not panic-inducing statements. The reality is much worse than they are letting on, but they are at least at a point where they must acknowledge it. So, since we're talking about the broader market, you notice that SPY has been bouncing off this level at 415 multiple times over the last several days, weeks. Notice we can't break above 416. We just can't do it. It's been bouncing off of it multiple times, and it's been bouncing off of the 200 period moving average this whole time on the hourly time frame. That's a sign that the resistance here is too strong for it to break through. Even though I think it is possible, but unlikely that the SPY could reach a high of $430. I think that if it does manage to get that high, it will get hammered rapidly as all of these major funds and banks dump their bags and we see full-blown fire sale. And it will only cause the downside move to be stronger than it would otherwise. Right now, they're shuffling risk. Market's going sideways and zigzagging between support and resistance. And it's stiff support and it's stiff resistance. But looking over the long term of what the market has done and what situation we are currently in, we can see that the market is very overweight and it is not going to be able to sustain its position for very long. It will eventually have to come down and relax. So bringing things all the way back to 2013, well, 2016. Let me work with a clean chart. Let me get a clean chart. Could you go away, IBK? Let's go away. Let's work with a clean chart. And let's show everybody the difference of the volume that the SPY has traded in just the last several years. We're going to look at something called a fixed ranged volume profile. It's also known as a volume shelf. Over here you have green bars. These are buying volume, and the yellow is the selling volume, or red bars. It basically just measures the overall volume in a direction at a given price. So between this price level, for example, where this red line is, this is where the most trading occurred. And that is between the price of $270 and $280. So this is where most of the volume was at. This is where most of the trading was because the price spent the most time in those areas. If you go ahead and take the, if you just take away from the peak and go all the way back to, say, mid-2014, you see that the biggest amount of volume that was traded on the SPY was way down here. because it spent more than 3 years down here. This is our area of support. And notice that when COVID hit, when the panic struck, this was the low point where it bounced off immediately. Now, if there is a crash, it is within the realm of possibility that it can come down that far again. Why? Because all the time that the price was climbing this rapidly, there wasn't enough time for the trading to build support at these levels. So there's a whole bunch of trading, a whole bunch of weight that is putting it's basically like having a stick with a weight on it, and it's like trying to, like, if you put a stone, or like a hammer, think of it like a hammer, a big hammer, a big sledgehammer, and you're trying to stand it up on its handle, and you've got the head of the hammer here at the top. It's very hard to hold that up. As soon as it gets a little bit off center, it will fall. And we've got a lot of weight here at the top. It's very top heavy and it's very unstable. So what I'm trying to say is that right now the SPY is showing a lot of weakness, and there's no support down here, at least not until about $280. That's the first area where we start to see some real support for the SPY. Maybe 300 or 305, but this is where the first area of support really begins to show itself, because that's where a lot of volume was traded many years ago, leading up into the COVID crisis. Now, since we don't have a whole lot of volume that's been traded in this price range that we've been in the last 2 years, there's not a lot of strength here. There's not much support to hold the price up. And if things start to go south, if we start to break through to what I suspect the breaking point will be $380 on the SPY, or $3,800 on SPX index, that we will see a fire sale. And we are trading below the 200 daily moving average right now. That's what this big rainbow is here. So just note that we are getting rejected by the 200 moving average right now. It's just holding itself here. And if we get rejected by this, then it's an extremely bearish signal, and all the banks and institutions are going to trade on this signal, and they're going to evacuate their positions rapidly because they know everybody else is going to be doing the same thing. It's just what you do. It's what the technicals say. It's what the charting indicates. So don't trust what institutions want you to believe, listening to mainstream media and assholes like Jim Cramer, who are just like, oh God, buy Netflix now, and then it crashes the very next day. Don't listen to that. Don't listen to what mainstream media is telling you. Use your own brain. Let's take a look at a couple of other charts and see how AMC is doing at the moment. Try to catch up with everybody. I went on a tirade for too long, and now we're getting ready to go into market close. Paul says rent is crazy, man. In Texas and Florida, I can't find a single apartment for under $1,500 in big cities. Jesus, I'm paying through the nose for my apartment. I'm paying like $2,400 for a 2-bedroom apartment. I'm not in those areas even. I'm not even in the overbought areas, and that's how much it's costing me. It's ridiculous. Thank you, Mr. Boulay, for taking care of that bot. Hey, Bounce, thanks very much. I appreciate that. Yeah, I am on Trey's side with that stuff. I don't subscribe to fantasies. I'm gonna stay realistic. HTCR, sure, I can take a look at it. Nope, gotta switch to stocks. Harcourt Enterprises Incorporated traded on the NASDAQ. Oh, that's quite a move. What happened to them? Authorizes up to a 3.5 million share buyback plan. Okay. Well, that is a good reason. That is a good reason to buy. 1 year price target is $7.85. They operate a software development company operating through the following business units for digital transformation, customer experience management, marketing, sales, services, and content management systems. Okay. Well, it's a good space to be in general. The tech sector is kind of hurting right now. It's a new stock, which is that's interesting. Um, I'm surprised to see that they're doing a share buyback so soon after their IPO. They obviously must have a lot of faith in their company. Market cap is just under $20 million, so they must have less than. Let's see. Go ahead and calculate this out. Let's do 20 million divided by their current. What was their last closing price? So they have less than 20 million shares out there in the market. Interesting. Well, I think that this will probably be short lived. Movements like this on an announcement of a share buyback is it's a good thing for the company. It shows confidence. Good for long term shareholder faith that the company believes in its own ability to generate revenue and create growth. I'm not familiar with their financials. There's not a lot of chart history for me to work with, though, so I can't tell you how it will perform over the long term. There's just not a lot of history here. So you'll have to do your own research and make your own conclusions based on a deeper dive of the financials and fundamentals. CRXT. I'll go ahead and take a look at that one too. CRXT is one that I expect to make a move, but I'm holding on to it for the long term, waiting for a FDA approval on their testosterone replacement therapy products. Hormone therapy is a pretty cool space, so I'm bullish on them overall. I think that they're pretty badly oversold right now. But this is one where I would say if you're looking at it for an investment, it's a long-term hold. And the problem is that now that they're down below $1, they're below the Nasdaq listing requirements, and it may get delisted. Wouldn't be at risk for delisting for at least another year, but it is a valid risk. So I'm in it, but I'd actually caution people to be careful because right now my position is down pretty bad. I would like to see some additional divergence on the RSI and the OBV and start to get the price to push back up over $1.
Hey TD, Bam
Yeah.
in the Discord chat had a quick question about VWAP, and I wanted to see if my understanding of it was correct as well. So I thought I would answer the question and have you correct me.
Well,
He
I
was
would
quickly-
say
Yeah, he was quickly wanting to know if it's good if something closes above VWAP at the end of the day. And from what I understood for VWAP, anything above that is going to reflect a bullish sentiment. Anything below is going to reflect bearish. You can also use VWAP as support and resistance during the intraday and trading day. When a price breaks above or below, that I don't necessarily in and of itself look at as one or the other, but it's a good time to really dive in and create some sort of breakout strategy.
yeah, sure. VWAP is a pretty good indicator of momentum, I would say. And if a stock is closing above the VWAP, then yes, I would. That is considered bullish. Let's go ahead and VWAMP.
Cool. Thanks, TD.
Yeah, sure. So volume weighted average price is just taking into account the volume and measuring the average price that a stock is being traded at. So when the stock price is below the VWAP, it means that for that day, most of the trades, the VWAP, I should say, this blue line here in the center, is showing the average price based on volume. So for the day, traders that made the majority of their purchases, they would have purchased at approximately this level, and this tracks the price. So when you see a break above the VWAP like this is a clear sign of a shift of bullish momentum. So this is pulling the VWAP up. So this is lifting the volume weighted average price with the price action, because now the price is moving above where most traders had entered their positions. So it is a daily indicator, so the VWAP resets every single day. So if you wanted to track this over a long term, then what you would have to do is use an anchored VWAP, which is a little bit different. That one anchors it to a specific price that you set up at the start of. So you could do, this is a VWAP with auto anchoring. Go ahead and close this out. So this one anchors the price based on pre-market open, and we can see where most of the volume was trading on the stock here. And then as soon as we opened up, the price kind of whipsawed people around and dropped from there. And now it's ripping back up going into close. So at this point, if CRXT, for example, since this is the stock that we're looking at, if they were to close at above 40 cents right now, then they would be closing above the VWAP, and that would be a bullish signal. So yeah. Let's go take a look at some of the other plays that we got here. We haven't looked at GME. I don't know why I haven't checked this one out yet today. But GameStop is it had a huge move in the last couple of days. It retraced to about 50% from its 50% of its previous gains the day before. So not a fantastic start, or end to the day, I should say. But it is starting to it is holding up support at 135 and bouncing from there. We've also got the RSI diverging as well. So if you see, we have a higher high over here, or a higher low, and a. Oh, I'm sorry. This is not divergence. This is just bullish. This is just bullish momentum. Price is low here. Price is higher here. That's a higher low, and the RSI bounced off of the same level. So this would be hidden bullish divergence, which is just trend continuation. It's not really divergence. It's just trend continuation. So based off of that metric, you would assume GameStop to continue on this trend until it doesn't. So here's an example of bullish divergence right here that may have signaled the move in GameStop. I'd love to show people this. So this is GameStop's price, and in both of these instances, you can see the RSI here. While the price was hitting its low points, the RSI was here at around 30, and then the price dropped down to this level in pre-market trading, and the RSI had actually ended higher. So while the price had established a new lower low, a low here and a lower low here, the RSI had a low and then a higher low at the same point. So this is bullish divergence. A little bit difficult to see, so I'll go ahead and stretch this out a little bit. You can see it a little bit more clearly in this area on the 15-minute chart. You can see that the price here had hit a low here, and the RSI was at 20.5, and then here at the next low, RSI was at 33.4, which is a higher low on the RSI, but you can see the price is lower than it was. It closed lower than this area. So this is bullish divergence. And then you see that GameStop had a nice big run the next day and the day after that. So be on the lookout for divergence. It's helpful for swing trading and day trading. Another thing that I find helpful to look for divergence with is the on-balance volume. I find on-balance volume to be extremely helpful for that same reason. On-balance volume tells you where trader sentiment is based on volume of trading. Go ahead and get this on the daily chart. So here is an example of bullish divergence on the OBV, and it actually diverges from the RSI index. So the OBV here shows that based on volume, because OBV is on balance volume, it's basically just it's taking the sum of green candles minus the sum of red candles for volume. And it's kind of just showing you where sentiment is. If more people are buying and if volume is higher and it's a green candle, then it's going to lift the OBV. And if there's more people selling and the price closes lower, then it's going to be a red candle, the OBV goes down. So you have this situation where the OBV is rising. We have this low here on the OBV. The price was at $106, and then the OBV lifted a little bit here at this next low. The price was closing at $78. So this is bullish divergence on the OBV. And then we had this higher low on it, and the price was at a close of $81. So not a lower low on the price exactly, but it was basically
that was
break
the close.
even.
Sorry to interrupt.
What's up?
I said sorry to interrupt. That was the close. Speaking of close.
Continue,
please.
Ding, ding, ding. So, yeah, I know I've gone on for a little while talking about all these different technicals, but I just wanted to point some of this stuff out because I can see that there are some bullish indicators on the OBV with GameStop right now, for example, with the OBV diverging, the RSI diverging, and this big bullish move, kind of forming a bit of a cup and handle, just a little one right in this area. If you look on the 2-hour chart, you could probably see it a little bit more clearly. Yep, so cup right here, handle here, and now the idea is that it breaks up to, it could go up to 180, but it's got to get through this resistance here at 150. Excuse me, 150, 155 area. So if it can break this resistance, then maybe GameStop will go on another tear soon after all. SFG Champ. I went over AMC. I think I went over AMC's Ortex data already. I'll go back to it really quickly. I don't really mind. If I didn't go over AMC's Ortex data, I apologize. But the Ortex data was pretty impressive. AMC, I think, is above 23.5% short interest. The short interest has been on a consistent rise while the price is showing a double bottom here and setting up for a rising bottom here. So we have a bottom here, a close above the previous low, and now we've got another close above the previous low and a big engulfing green candle. So every single time, ever since May 25th, we've had green engulfing candles swallowing up these big red candles. So right here is what I'm talking about. This big green engulfing candle completely eats the previous red candle. And you see that there's a big move to the upside. So now we just had that again. AMC is probably, I mean, it's more or less consolidating today. It only went up like 25 cents, but I'll still take it. The thing that I am most interested in seeing from AMC though is for the cost to borrow to start rising, which you can see it is clearly doing. The cost to borrow on AMC is basically going parabolic. I can see the cost to borrow average is still only at 30%, but overall, we can see things getting more and more and more expensive for shorts. So if our thesis holds true, then they won't be able to sustain this borrowing for too much longer. A good way to continuously be putting pressure on shorts and making things more and more expensive for them is if you're using a broker that enrolls you automatically in short lending or share lending or stock lending programs. Look for those words. Anything that says stock or share lending is basically lending out your shares for shorts to borrow and short against the stock. So if you're doing that, if you're participating in brokers that will lend out stocks on your behalf and then pass you a premium, you're actually hurting your own positions because the stock that you've purchased is now being used to be shorted into the market. And that's, it in theory is good for price discovery, but it's bad for your thesis if you want to see AMC squeeze. So take note on these factors, and if you want to get out of that lending program, you need to contact your broker and let them know, I do not wish to lend out any stocks or shares. If you are lending my shares, I want to opt out of that program. Make sure that they give you something in writing that says that you are not in any share lending program, because I'm willing to bet that a lot of brokers, including my broker, which is Fidelity, is not being very forthcoming about their lending programs. And if that turns out to be true, if they were lending out stocks and not passing off their funds to their customers, and also borrowing their stocks without telling them, that's a huge, huge FINRA violation. So, yeah, make sure you get that in writing like I did, and I'll be looking forward to joining the class action lawsuit to come eventually when all of that comes to light. Let's see. All right, so I'm really sorry that I haven't been able to look at absolutely everybody's tickers. Y'all keep me busy. I will say that y'all keep me very busy, but I'm happy to do it. I'm really glad to be able to bring you guys this information. I think I pointed this out on my AMC analysis video the other day, but the utilization has been maxed out at 100%, and since that time, the number of shares on loan have gone from 118.5 million up to 122 million shares on loan. Or I'm sorry, that's not even on loan. That's just a short interest. The shares on loan have gone from 118.5 million up to 183.5 million. So nearly 184 million shares, or almost a 606 share. Oh, Jesus. I'm trying to do head math and it's just not working, so I'll just get the calculator out. A 65.2 million share difference. It's a 65.2 million share difference approximately in the amount of shares borrowed against AMC. So just based on those numbers alone, like there's a huge disparity between utilization and the amount of shares that market makers and brokers are actually able to find. How they're able to do it, we're not exactly sure, but they always manage to find some more shares. But this is a good thing because it's making it more and more expensive for shorts to continuously take positions against it. And the more people that take their shares out of lending programs, forcing brokers to work harder to find those shares to short, the harder and more expensive it will be for shorts to maintain their positions, and it will continuously put pressure on them to cover. Further to that point, we've got spikes and failures to deliver that are happening consistently in the last several weeks, and it's not been quite to the level that we saw previously in 2020 when we were spiking up to like ridiculous like 25 million failures to deliver when AMC was about to go to $20, or even the FTD levels at like 11.7 million when AMC went from $10 all the way to a meteoric 70 per share. But we are seeing that consistently the FTDs are spiking and climbing again. So it's taken a long time, but remember that there's a bigger float out there. There's more shares available than ever before. And we do recognize that there's a lot of shady stuff going on at the brokerages that they're not telling us about. So it's a matter of just being patient. We're probably going to have to wait some time yet for any squeeze to take place. Just so that I've gone ahead and gotten this out there in front of everybody, I still hold on to all of my AMC stock. I still think that AMC is going to go to the moon, but for me the moon is like $300, $400, $500 or something like that. I'm not going to hold it for $10,000 or $100,000 or ridiculous things like that, numbers that aren't even possible. It's only theoretically possible because there is no limit to infinity, and that is what is meant by theoretically possible.
Well, technically, depending on how bad inflation gets between now and then.
Fair enough. Like for me, I look at AMC going to $100,000 is like, out of all of the atoms in the observable universe, you get the ability to pick one, and that is your. And if you can, then yes, then it'll happen. Like all the circumstances come together, you manage to pick the exact atom in the entire known observable universe. Yeah, it's just it's beyond infeasible. So I know people are pissed at me. You can be pissed at me, but ain't no way that an American theater chain is going to be worth twice as much as the entire United States gross domestic product. It's not
There's
happening.
a chance, right? There's a chance.
People have to realize the tactic here too. I mean, we saw GameStop and AMC do stuff that we never thought possible. And then we saw many other meme stocks do their own squeezes and whatnot. And the more normalized that gets, and the higher the expectations become set by mystery people in social media and mainstream media and all over the place. And I use people with finger quotes. You're just increasing the total number of disappointments that all of those people are experiencing. Instead of just having one exceptional thing and that was it, now, or maybe 3 awesome things and 2 negative ones, still good. Now they have like 1 or 2 awesome things and 20 shitty ones.
Yeah.
And that's exactly what they want you to feel, because man, I believed in this so hard, and now you're not going to say it's going to happen, and now you're killing my hope.
Yeah.
There's only two types of people that are saying 100,000. The ones that are still riding the hopium train and the hype train and trying and just regurgitating the information, and the other type is a malicious person that's putting it out there in order to be able to sell from underneath you whenever you were holding into 100,000. Exactly. Just be careful of these people. Like, yeah. One's uninformed and one is informed and using it as malicious intent. You got to take it upon yourself in order to figure out who's who and just do your own research.
Yep, absolutely. You got to be careful of people that are trying to sell you a story. Something else that I just noticed, Ortex put a new figure on its charts showing the put call ratio, and put call ratio is the higher the number, the more puts there are, the lower the number, the more calls there are. So put call ratio is a balance between the two. So anything below 0.5 is bullish because that's, it technically means that there are more calls open than puts. So the closer the number gets to 0 would indicate that AMC is turning bullish with the amount of calls available and open on the market. And I noticed that each time that AMC had a big turn towards the bullish side with the put call ratio was right before it squeezed. So the last time AMC had a put call ratio of 0.41, and now it's got a put call ratio of 0.44. I find that kind of interesting. I never actually looked at a put call ratio on a trend chart, and it's kind of interesting. I see the put call ratio getting blown out towards the middle of June after it moved to $70. And honestly, I think I wish I had seen this. Maybe I wouldn't have held on to my calls for so long. Maybe I would have bought some puts to kind of hedge myself. I know that people get upset about the idea of buying puts and buying and selling puts for some reason, even though selling puts is a bullish bet. But I mean, the thing is like, isn't the point of this to make money? And if you want to help AMC squeeze, like everyone's like, no, don't ever sell your shares. But like, if you had a put that was set at a strike of $70 and you bought that put so that you could sell your shares at $70 even after the price fell all the way back down to $10 or whatever, you could exercise that put. You could sell your 100 shares for $70, and now the price is back down to $10, so you could buy back 700 shares. So just because you buy a put, acknowledging that the price is going to come down, does not mean that you have to be like bearish and against the stock. I really wish that people would not take such a black and white stance on this, because one of the big, oh my God, this freaking bot is back. Let's get this thing the hell out of here. Okay. Like I was saying, I wish that people wouldn't take such a black and white stance on puts versus calls, because the options market might be like what influences the stock, but you should still be protecting yourself. If the idea that you want to help AMC squeeze by accumulating shares, that's great. But if you don't believe in selling your stock, then, and you see that the price is going bananas, then wouldn't it make sense to go and buy a put to cover your stock and protect that position? Because if you see the price go up to $70, and I should have done this, I should have bought puts when it reached that price, because I knew it had to come down at some point, and I didn't. I just sold my calls and held on to my AMC shares. I should have bought puts, because then I could have taken my shares, I could have exercised the puts, I could have sold them at $70 and then immediately bought them all back 10 times over at $10 a share. And I would have multiplied my AMC position and I would have further eaten the float by doing that. And you can't time the top perfectly, and I'm not saying that everybody should attempt to try to do that, but if you're being smart and you really believe that AMC can squeeze to these ridiculous levels, then it makes sense that when AMC makes a huge move like that, you say, okay, there's a possibility that they might hit it really hard with some more shorts and they might try to cover their stocks. So I think that I should possibly sell a out the money covered call, and I should buy puts. And if the price comes down, then I keep the money from selling the calls. I exercise the puts. I get all this money. I unload my shares in the time that it takes to exercise those puts. I get all of that money, and then I take that money and I just buy more shares of AMC at a huge discount. Like, doesn't that make sense? I wish that other retailers could think that way. I wish it wasn't like that I'm evil for thinking of purchasing a put against AMC. The whole point of this is to the whole point of this thing isn't just to make AMC go up forever. The point of this entire movement is to educate retail and make the market fair for everybody. It's not about AMC going to 100,000 just to fuck over hedge funds. And even if it did, like, the hedge funds would find a way to make money on it going up like that. So it's more about educating retail on how to play the market and for us to win. It's not about just making one stock go up forever and then, I don't know, closing the wealth gap with a single fortune making move in the stock market. It's not a realistic thing to believe in. Even if AMC did do it, it wouldn't change everybody's lives because the stock market would still be structured the same way it is, regardless. We have to change the way that we play the game. I don't know. That's just my take on it. Well, it was nice to see everybody. I guess I'm sorry for all of the all of the rants. I've been going on and on and on for the last couple of hours, but hopefully everybody got something out of it. And there was some education to be had. So in the near term, AMC starting to show some serious strength. I'm really looking for it to close the gap up here to 1550 and then retest this resistance. If it completes this cup and handle formation or double bottom pattern, depending on how you look at it, the upside potential of this could see it returning back to above $20. We have to break up out of this falling wedge pattern that it's been in for a long time. So it'll be difficult to do, but the potential is there. So really looking forward to seeing how AMC responds to this $15 level. GameStop also showing some serious strength. It needs to make a bounce here at 135. Looks like it could be getting ready to do that. If it stays on trend to hit $180, this is where a big area of resistance is at. It's already touched it once and then twice again a couple days after that. So GameStop could show some strength and breakout, but we'll just have to see how it goes. Reminder that I am bullish on Ollie, the discount store chain. Their earnings, they missed on earnings, but that really wasn't what investors were waiting for. They were waiting on guidance, which was very positive. So this is a stock that I believe that over the long term can actually double in value between 180 and 360 days. Going from its current price now at like $50, I think that anything below 60, 65 is honestly a steal. So yeah, I'm very bullish on Ollie for the long term. SPY, very bearish. It's starting to show some serious weakness, consolidating sideways, and it can't break above this $416 level. If it breaks down and gets below 390, I think that panic will ensue if it completely collapses and drops below 380. And at that point, I'm basically looking at the bottom somewhere down below 260 over the near term between now and the end of next year. I'm pretty sure that covers all of the topics that I came here to chat with you guys about. Hopefully you all had a good week, and hopefully I'll be able to come back and do this again soon, and keep up the momentum and keep up with my streaming schedule. So thanks again, guys, for watching. One last time, if you are new to this place and you haven't been here before, and you're interested in being a part of our community, it's called Hell's Trading Floor, which you can join by going to discord.gg/Hell's Trading Floor and sign up through our Patreon link. Membership starts at $3 for the smallest membership fee, and you can get access to all of the Discord, talk to all of the traders, professional traders or amateurs, and as well as our analyst team, and get access to our data analytics platforms and bots that we have available. All of that is housed within our Discord, and every member has access to the basics. If you want to pay a little bit more for the professional tier, we also have our proprietary Scourge bot, which helps us call out squeeze plays and points out areas and stocks that are going through major volatility and momentum shifts. So, yeah, that is everything, you guys. Thank you so much. Thank you so much for watching, and I'll look forward to seeing you tomorrow, and have a hell of a time in the markets.